Accounting is far from an engaging subject. Because of this, one's mind tends to wander. This mind wandering usually turns into some fairly in-depth daydreaming. This story is about one such daydream, a story literally written and recorded during an accounting class. So without further ado, let us begin. Act 1. The Unrecorded Revenue. Before any story can begin, some backstory has to be provided. To begin, what is unrecorded revenue? Unrecorded revenue is revenue that an entity has earned in an accounting period, but is not yet recorded in its financial statements. This usually happens when a company has provided goods or services to a client, but has not invoiced them yet. Because of the nature of unrecorded revenue, there is no journal entry for it. However, in the case of interest earned, the total interest earned is calculated at the end of a period, and this value is included in a business's financial statements. Interest earned on a daily basis, however, is not recorded in the general journal. Now, on with the story. Every good story needs a band of heroes to follow. Here we introduce trial balance, balance sheet, and income statement. All three heroes have donned the nickname of a financial statement from years of experience in the field. One day, General Ledger, the leader of their village, informs them that a dragon has been practicing improper accounting practices and violating many GAAP principles. That was the final straw for the heroes. They set out at once to defeat this accounting abomination. Act 2. Oh, how we depreciate. Before the heroes can begin their journey, they first must understand the concept of depreciation. Depreciation is when the monetary value of an asset decreases over time due to use. This decrease in value has to be recorded in a business's financial statements. This is done by using one of two depreciation methods. The first method is straight line depreciation. Straight line depreciation is calculated by subtracting the salvage value from an asset's current value and dividing it by the life expectancy of the asset. The next form of depreciation is called declining balance depreciation. Declining balance depreciation is calculated by multiplying an asset's current value by a predetermined depreciation percentage. To journalize depreciation, all you have to do is debit the depreciation expense and credit the accumulated depreciation. Now, back to the story. After a day's journey, the heroes are ambushed by the dragon. "Why are you in my forest?" says the dragon. The heroes are taken aback. Balance sheet is the first to respond. "We have come to put an end to your terrible accounting methods." "Is that so? Well, to do that, you'll have to slay me first," says the dragon. The heroes pull out their ledgers, ready to fight. "Actually, I'm not in the mood to fight. I have more assets to depreciate," says the dragon. In seconds, the dragon disappears through the forest. The heroes know they must act quickly. If they don't act fast, everyone's assets will be reduced to salvage value in a matter of days. Gathering their things, the heroes make haste and follow the dragon's path, knowing that they are in for a fight when they find him again. Act 3. How to deplete one's assets. To defeat the dragon, the heroes know that they must use one of the dragon's own abilities against it. To do this, they must learn about the depletion of assets. Depletion of assets is the gradual loss in monetary value of a business's assets. These assets usually take the form of office supplies or other one-time use materials such as gas. Unlike depreciation, depletion is not so much calculated as it is determined. This is done by counting the value of assets at the beginning of a period and at the end. Then, you subtract the two to find the difference. This difference is the depletion in value of the asset. Journalizing depletion is the same as depreciation. However, here, you debit depletion expense and credit accumulated depletion. After days of tracking, the heroes finally find the dragon in a frozen cave. Shocked by their presence, the dragon gets ready to fight and attacks the group. The heroes know they can get the upper hand if they determine the dragon's asset depletion fast enough. While balance sheet and income statement fight the dragon, trial balance goes into the cave to count the dragon's assets. Here he determines that since the last time they saw the dragon, it had lost a significant amount in asset value. Trial balance makes a quick journal entry and severely weakens the dragon, causing it to change colors. Realizing it can't win the fight, the dragon runs off. With their audit successful, the band of heroes rest for the night, knowing that the next time they encounter the dragon will surely be the last. Act 4. Always record your liabilities. Despite being expert accountants, no one is perfect, and heroes often make mistakes. In this next chapter, the heroes will learn the importance of properly recording their liabilities. Before we can get into that, however, what are unrecorded liabilities? Unrecorded liabilities are liabilities that a business has incurred during an accounting period but have not yet included in their financial statements. This usually happens when a company receives late arriving invoices. To journalize these liabilities, all you have to do is debit the given expense and then credit the amount owed account. For example, if a company had an interest expense on their credit cards, they would debit interest expense and credit interest payable. Despite being so simple, this simple journal entry will turn out to be the hero's downfall. The heroes approach the dragon for what they assume will be the last time. However, the dragon is smarter than they gave it credit for. While they were tracking the dragon, it had been auditing their financial statements as well, and noticed that Trial Balance had accidentally recorded a late arriving invoice on income statement instead of balance sheet. This was disastrous for income statement, as with a liability on him, he couldn't use his abilities. In seconds, the dragon had overpowered him with his superior knowledge of the materiality principle, and he was put out of the fight. Trial Balance followed soon after. Due to his transposition error, he was powerless against the dragon's onslaught. That just left Balance Sheet. Due to him lacking liability, he was far more powerful than before. This allowed him to use the power of his assets to fend off the dragon long enough for Trial Balance and Income Statement to get away. But he couldn't stop now. Balance Sheet would have to defeat the dragon by himself. Act 5. How to earn one's revenue. Balance Sheet knew that to defeat the dragon and earn his reward, he would first have to journalize his unearned revenue to increase his power. This would, however, make him liable for it, so he didn't have much time. Before the final battle, Balance Sheet would have to review the concept of unearned revenue. Unearned revenue is money received for a product or service that has not yet been provided or delivered. As a result of this payment, the seller has a liability equal to the revenue until the good or service is delivered. This is because the buyer still has a claim on the money until the service has been provided. To journalize unearned revenue, you debit an unearned revenue account and credit a revenue account. This way, the unearned revenue is not mistaken as actual revenue. With this information, Balance Sheet was ready. Balance Sheet met the dragon at a volcano. Here, both of them had all their assets at their disposal. They both began auditing each other. Balance Sheet corrected numerous accounting errors made by the dragon. He made the totals in the dragon's worksheet equal, he corrected improper credits and debits made in the ledger, and he adjusted the dragon's assets for depreciation. However, the dragon was not done yet. He recorded the late arriving invoice on the balance sheet. However, before the dragon could do anything else, Balance Sheet pointed out his numerous GAAP's principle violations. This was the final blow to the dragon. With the dragon gone, his improper accounting practices would no longer wreak havoc on the village. With the day saved, Balance Sheet went back for Trial Balance and Income Statement, and they went back to the village to change their unearned revenue into revenue. The end.